That's a good start.
He's got his crystal ball too for us.
Oh, awesome. Awesome. If that's the case, I need to speak to you after the meeting as well. Especially after a 2020 year like we had.
We're live now.
Okay, got Mary Kate. Hi, Mary Kate. How are you?
I'm good. How are you, Mac?
Good, good. We got Maurice. Hi, Maurice. How are you? Just checking for trustee members.
Mike is here, Nanette.
Yes. Yeah. Thank you.
And hey, are we waiting for anyone else?
No, we have Mike. We have all trustees. So.
Excellent. Ready to get started then. Good afternoon, everyone, and thank you for accommodating my need to move this meeting a half an hour back. Hopefully, we can be as efficient as possible during the call. But why don't we start with a roll call?
Yes, Max Starks.
Here.
Did I mute myself?
Nope. We can hear you.
Sorry, Maurice.
Here.
And Mary Kate.
Present.
Thank you.
Excellent. Great. Well, thank you all. Why don't we jump right in? Michael Chase, take it over.
Okay. Let me share my screen. Okay. Hopefully everyone can see that okay. Just
yes.
Move
no
it
issues.
over to my other monitor here. Still good?
Yes.
Hold on. Your screen sharing is paused. How do I? There we go. Okay. All right. So we'll walk through the fourth quarter of 2020. It was an interesting year, to say the least. Just from a housekeeping standpoint, we did finalize actually our merger with DeMaio Schneider. So that is done. It closed legally as of 12/31. So we're now one RIA. So that is done. And as a result of that, we're up to about 200 billion in assets that we oversee. We had some nice kind of recognition in the press after the merger, and we started to roll out a bunch of different programs, which was the goal of bringing these two organizations together. So we're pretty excited about the merger, and it's been going smoothly, and hope you'll continue to see some of the benefits of that as we move forward. From a governance perspective, this is a big lift this quarter. We always focus on allocation. This year, I think it's particularly important given the scenario that we find ourselves in and where the capital markets sit. So we'll spend quite a bit of time focusing on what our forward-looking expectations are, how the portfolios are aligned, and making sure that they kind of stay in tandem with the objectives. So that's what we'll spend most of this time on. As you would imagine, maybe given kind of where the markets ended the year, generally risk assets, equities were up about 20%, which is, I think somewhat surprising given where we sat in the March and April time period. So risk assets and equities were generally up, which brought their valuations up, and then interest rates dropped dramatically. And when interest rates drop dramatically, it has a strong impact on what we can expect from returns from fixed income investments on a forward-looking basis. So what this chart is showing you is that our assumptions from where we sat last year to this year are down pretty dramatically, particularly on the fixed income side, over at 1% annualized on a forward-looking basis as a result of that. And the equity side is generally down a little bit too. So there's definitely implications here in terms of what that means from reaching return goals on looking forward. And if we need to look to decrease fixed income and increase equity, what that means from a volatility and risk perspective. So that's what this conversation is really going to be about. Just to level set, we're focused on the long-term pool here. Again, this is not a true endowment, so to speak, but it's invested like a long-term pool of capital. So we don't have any kind of expectations for significant inflows or outflows. And then liquidity kind of needs to stay where it has been, just in case we do need to draw, the school needs to draw on it for any projects or kind of important considerations from an operational standpoint. Here's the investment policy in terms of where our target asset allocation is and where we sit today. You can see we've been running the portfolio a little bit underweight fixed income as a result of where interest rates have moved to and how strong equity markets have been. So that's been a little bit of a tailwind, but kind of resetting it based on this current allocation, maybe making that the strategic is really what this conversation is going to be about. And really to kind of put some of the numbers to paper here, and this is a new chart. This is our new asset allocation modeling tool, which we built internally. There's a lot of numbers on this page. So let me just walk you through it. This first light blue bar, this allocation is what I just showed you on the last page. This is the target allocation as set forth in the policy. So it's about 30% fixed income, 55 equity, 8 in real assets, and 8 in alternatives. And these kind of are this kind of underlying sub asset classes that make up the portfolio. But the important numbers are over here. So this portfolio with these forward-looking revised capital market assumptions built in are set to generate about a 6.3 expected return with an annualized volatility just shy of 12% on a forward-looking basis. Kind of where we sit today is this first light or white bar, excuse me, or about 25% fixed income, 59 in equity, 9% in real assets, and 8 in alternatives. So you can see that's actually the expected return there's a little bit higher, 6.5. This actually this keeps us in line with where we sat last year about trying to get that 6.5% return target on this long-term portfolio. You can see that increases the volatility a little bit, 12.6. You know, these next two columns just give you a sense of what that actually means. So if you look at a kind of a non-normal 100-year flood, this is looking at a kind of a tail risk event, right? Or if you draw the distribution out, this is in the far left, you know, kind of 1 in 100 type scenario. And in that scenario, we would expect this portfolio to be down about 31%. That's just a little bit more than kind of where those policy targets sit. So our thought and kind of our expectation is within the policy range is actually to kind of reset our footing from a 30% target to a 25% target on a forward-looking basis to kind of accept that small amount of increased risk and volatility, but keep us on that longer-term average of that 6.5% return. We built in some additional models here where, just to give you an extent of if we decrease it to 20 or 15 on fixed income, what that means, just so you can see what the numbers look like. But I think the goal of this conversation, I would open it up to Mac and to Dr. Cook and the trustees. You know, I think keeping us on par from what we know from an objective standpoint is this scenario here. But if there's anything that we should be aware of in terms of an upcoming need for these assets or anything that's impacting the college here in the short term, or we may need to lean on this long-term pool, we just want to make sure we're having those conversations or on the same page before moving forward with that reset. So maybe I'll just pause there and just open up the forum just to see if there's any input or anything that we're missing with this.
Yeah, Mike, this is Mac. So nice new chart. You know, I'm sure once I see it more often, I'll get more comfortable with it and start to like it even more. But just first question is the annualized volatility. So how should we interpret what that means?
So basically, Mac, that is you could expect you know, 2/3 of the market outcomes if you kind of ran this through 10,000 trials to fall within 12, you know, plus or minus 12% of this, you know, this median return target. So that kind of sets where the majority of the returns could be. So, you know, 2/3 of the time the returns are going to be somewhere between plus 19% for a calendar year or negative 6 or 7% of a calendar year.
Got it. Okay. Okay.
I can pick up that one comment for our trustees. I would just say, you know, the positioning from Mike, and it's hard to say DeMayo Schneider. I'm so used to saying FIA Mike. That's going to take some time. Is the long-term capital sort of consideration for us with this pool of money, right? Is that building 20, that School of Health project. And so as that sort of comes closer into relief, as we work with the state on that, right? As we seek what's the tolerance from trustees in terms of a commitment, I think that's where we could help you with some better clarity around $3 million, $4 million, $5 million? What's the positioning from our trustees around a future investment in a project like that?
Mhm.
By the way, right, Mike, that what we see in early sort of budget work is it's a project that's somewhere between 35 and 40 million. And we know we're not going to be able to get all of that. It's likely, particularly in the current economic situation, to even expect anywhere near close to that. So that's the sort of outlook down the road I want to just be sure that you hear from us.
Yeah, I think, Mac, that would have been my comment too, is as we prepare, right, short term, long term, and what those definitions really are. I think it's going to be important from if we do need capital money. And I'm going to always defer to you and your expertise and the when, the how, the where we pull. Just want to kind of raise that, that we might find ourselves in that situation down the road, not tomorrow, but somewhere down the road.
We might. Yep, exactly. Yep, it'd be interesting to see how much we get, and then we can make bigger decisions. So it's not just a money decision. But yep, I'm with you.
Okay.
Slide,
So
though.
I think what you'll see when we get to the portfolio is that kind of through market movement and us wanting to be a little bit overweight equity, we've kind of naturally shifted to this. So this is not actually of a kind of an increased risking up of where we sit today, but basically kind of just aligning things here modestly on a forward-looking basis. So we'll start to see that reflected going forward. And again, this is something that we'll continue to evaluate at least annually. And as we get more clarity on any projects, either the health building or anything else that comes down the way, we can always evaluate this ad hoc. So something we'll always keep front of mind. Other things that we're doing in the portfolio to kind of help with this scenario is a slight increase in emerging markets. We like the growth outlook and evaluations of emerging markets relative to US markets right now. Maintaining that exposure to hedge funds. So that's one of the tools that we're using, that if we're going to have less in fixed income, how do we dampen volatility as much as possible? And we really lean on the hedge fund allocation to accomplish that. The way we build that is a very kind of conservative multi-strategy approach. It's not some of the things you've been hearing in the journal over the last couple of weeks, but a very kind of market neutral approach where just the alpha that they create with their trading is basically there as a, I won't call it a fixed income substitute because there's certainly a little bit more risk involved with it than that, but it is not a kind of a levered up long short strategy. Any other questions on the governance or that asset allocation work before we go into markets in the portfolio?
Nope, not for me. Everything seems to look like it's in line with tolerances. So
Okay.
No questions for me.
So we ended 2020 with very strong market outcomes. Fourth quarter was extremely strong. That's on the kind of the tail end of certainly a lot of kind of volatility in the September, November timeframe around the election and results, et cetera. But you can see the S&P was up about 18.4 year to date. That was driven primarily by large growth stocks. As we touched on last meeting, the NASDAQ was up 45. And if you compare the value and growth style of investing, growth was up 39 for the year. Value was up 3%. So it's a huge dispersion for the year. But what you will see is if you look at the fourth quarter, we did see that kind of trend pause and revert pretty meaningfully. Still a ways to go, obviously, to get back to neutral, but you can see the growth was up about 16%, or excuse me, value was up about 16%, where growth was only up 11 for the quarter. And similarly, that was the case across really the global markets, mid cap, small cap, and foreign markets. And actually, foreign markets were notably ahead of US markets for the quarter. Emerging markets up just shy of 20%. So we did see a pretty meaningful flip-flop on market leadership, and the portfolio really benefited from it. As we touched on really for the course of the year, but really last meeting, we had some themes in the portfolio to try to participate as much of the upside on the equity markets as we can, but stay diversified, not kind of chase those growth equity returns, and think through what might work on a forward-looking basis. And I think one quarter is not enough to say we won the war on that, but it was positive in the way that the portfolio responded as we started to see market leadership twist a little bit. So we'll dig into that. From a valuation standpoint, you can see US markets look quite stretched. This is looking at a CAPE ratio or cyclically adjusted PEs. The blue bar is median. The green circle is where we ended last year, and the gray circle is where we, well, excuse me, where we ended 2019, and the gray circle is where we ended 2020. So dramatic kind of valuation mismatch between what the long-term average has been here in the US. And certainly in the foreign markets, markets don't appear inexpensive relative to long-term averages, but on a relative basis, dramatically less expensive than the US markets. So something we're paying close attention to, and certainly something that the active managers in the portfolio are paying very close attention to. On the fixed income side here, you can see the treasury curve. So the curve actually moved up pretty dramatically, not on a absolute basis, only about 35 or 25 basis points, but on a relative basis, pretty dramatic. If you think about at the summertime, the 10-year was at about 50 basis points at one point. Today, it's over 110. So that's a pretty dramatic shift up in rates. So that has been mean that just owning kind of intermediate treasuries has been a negative holding since March, and owning anything that's focused on global exposure, non-dollar, corporate bonds, anything spread related in credit has had a really strong tailwind associated with it. And you can see the dramatic outperformance from those sectors here in the quarter. And again, the portfolio, when you'll see it, has benefited from that. And you can really see how sharply the spreads gapped out in the middle of the crisis, and really how quickly they've tightened back in as conditions have improved. So what that all means is we do have a slight tilt toward the equity side, as I just went over in that asset allocation study, which will memorialize in the portfolio, a slight tilt toward emerging markets based on my other comments, and then maintaining a slight tilt toward credit and spread products and the fixed income allocation. So if there's no questions on the markets in general, well, we can dig into the portfolios and see what the implications there are.
No questions. Just nice to see the fourth quarter bounce back. So strong. It was to your point, it was remarkable actually.
It really was. And when you look at the numbers, and I'll fast forward to the long-term pool. So we ended the year just shy of 13 million in the long-term pool. You can see again a little bit about 5% underweight fixed income, the resulting overweight in equity. So we're just going to basically switch these targets to memorialize that, but kind of right where we would expect it to be. We did make one change in the portfolio. We actually swapped Conestoga Atlantic Capital for Conestoga. They're both small cap growth names. We have a little bit higher conviction in Conestoga on a forward-looking basis. So while we still think highly of Atlantic Capital here, you ultimately pay us to have our highest conviction managers in these portfolios. So we did make that change. They're both quality focused growth managers. And we think that's important in the small cap space. If you look at the small cap growth returns, it's been led by companies that are not profitable. And while that can work in the short term, if there's a lot of speculation, that's generally not a great place to be positioned. If a company's not earning profits, it's not going to last a whole lot longer. So in theory, there's been a lot of speculation around vaccines and healthcare stocks and biotech stocks in the small cap space this year. Conestoga and Eaton Vance participated in a good chunk of the rally, but not nearly the same extent, because generally they're looking for companies that are going to be profitable to hold in their portfolios. So we kind of like that posture on a forward-looking basis. From a return perspective for the quarter, the long-term pool is up 12%. That was 170 basis points ahead of its benchmark. Fiscal year to date, it's up 18.4 and about 250 ahead of its benchmark, and essentially has kind of caught up to lagging kind of through the first quarter as a number of those postures were out of favor. So to my point on some of those managers, whether it's value or spread product or quality focused managers or focused on profits, were really rewarded for kind of staying true to those exposures through the tail end of this year, which we're happy to see. And our hope and expectation would be that continues on a move forward basis. I won't go through all the managers, but just to give you a highlight, the fixed income allocation had an extremely strong quarter, up 3.1 when the ag was up 70 basis points, which brought us up 9.4 for the year versus 7.5. That was a lot of headwind to make up where we sat from March. So kind of staying true to those tilts was a nice benefit. The domestic equity side was up 16 versus 14.7 for the quarter. again, really being driven by having an overweight to value. That was still a headwind for the 1 year and really has been since inception. There's no getting away from that. But again, staying true to Diamond Hill, you can see if they're up 24/7 for the quarter, well ahead of what the S&P did, double what the S&P did, and well ahead of its peers. And they've been a very good manager for their where they're kind of chosen to play in the investment universe, right? They're a value manager. They were up 15% on a 1 year basis, which was 1,200 ahead of where the benchmark was. So having a value exposure was a headwind, but definitely having a manager that had a very strong year and that we think very highly of helped offset that tilt to an extent. On the international side, the portfolio continues to perform very well. It's really been additive over the benchmark over every time period. This year was no exception, nor was the quarter. We saw Dodge and Cox come back into favor being the value manager. Again, they're well ahead of their peers, and the MFS has been a very nice holding really since we added them to the portfolio, as has Schroeder. So everything there kind of moving where we'd expect it to and creating quite a bit of value. And then lastly, on the alternative side, both Principal and Cohen & Steers have performed well. Cohen & Steers, we swapped out in the middle of this year, and that was a good decision. They've outperformed Morgan Stanley, which was the legacy manager and has been one of the top performing REIT managers thus far. And then Atos, shows behind their benchmark. But again, Atos, we actually picked because of their conservative nature. So we're kind of willing to kind of give up a little bit relative to some of their more risk-on peers. This hedge fund of funds composite is really a universe of all hedge fund of funds. So it includes some very aggressive managers, some very conservative managers, and this is just the median return. So generally plotting where we'd expect it to. But I think importantly, and why we own them, is you can see in this quarter, they were up 6.6 when the ag was up 70 basis points. So to the goal of kind of shifting some of that role of volatility dampening and diversification away from fixed income, and hopefully an effort to increase returns but maintain that profile forward looking, this is what we're hoping to achieve from them. Not a lot of negative things to say in the portfolio. Not every manager was ahead of its benchmark, certainly for the quarter, for the year, but I think all things considered from what we experienced through March and then the rebound, we're pretty happy with what the results were, and I think have a pretty high conviction in where we are postured on a move forward basis. But again, I'll pause there and just see if there's any specific questions on managers or the exposures.
No, I think you did a very good job of laying out, reasons why we swapped out, why we stay in certain managers, and just based on the performance. To your point, I mean, nothing's considerably worse than the average that we're comparing them against. So I think a great story.
So that's the long-term pool. Flipping over to the short-term pool, right here is a lot more conservative. On a 1 year basis, it was up 2.3%, a little bit behind its benchmark. But here the goal is to do better than what you can get in cash. So 2.3 versus essentially 0 from cash is what we're designed to do here. Looking at some of the underlying managers, Payden, who had a tough March, has kind of bounced back. And again, relative to what you get in cash, this is what we're expecting to see from them. Tia Kref, which is a social mandate, which has a little bit longer duration profile, was added as rates came down. And then Vanguard to complement that. So I think everything moving in the right direction here as well. No concerns with these managers, and obviously a very different risk profile and return objective from this pool of capital.
Agreed.
Two notes. One. Let me just work in. By the way, Mike Chase, Andrea Nathanson, you'll see there is our new VP of Administration, CFO. She may want to ask some questions offline. We can certainly help set that up. But
sure. As
context for her, two things come to mind. One is that this is relatively new for us, right, trustees? That I think we set this up as a quasi endowment only back in 2015, if I'm not mistaken. I don't know, Mike, if you remember offhand how.
Yep, we have it. I think it was very different when it was actually right at the tail end of 2014.
2014. So it's amazing to see the sort of maturing of where we are. And Andrea, again, this is a fairly recent conversation, right? Not even 10 years in this sort of way that the college, in partnership with trustees, has sort of done this investment. I think also it's noteworthy to Mac and others that we're at about 18 million total under investment. That's the number we were at before trustees greenlit 3 million to finish off building 19 and that $50 million student learning commons. So I think, Mike, if I'm not mistaken, we were at about 18 million when trustees again approved usage of that for that building project, and we've now worked our way back.
Yeah, you can see that right here, Dr. Cook. If you look, beginning market value on November 1st, 2014 was 18 million.
Yep.
We've pulled out 4.7 million. You've earned 4.6, and it basically puts us right back where we started.
Yeah, it's great. It's just amazing how the markets work, of course, but that seems worth pointing out that we're kind of right back where we were there, and with some really significant capital work on campus to show for it.
That's a great call out, Dr. Cook. Yep.
So that, Mac, is everything that I had prepared formally, but obviously if there's questions or anything that we can provide some insights into, we're happy to do that.
Yeah, I guess from my perspective, I mean, you did a very good job of covering the bases here. I mean, it's, I expected a good quarter given what happened in the market, overall, and we're seeing that play out here. As we walk through each one of the managers, looks like folks are performing well. You did a great job of walking through that one swap out that you did make, and it makes sense in terms of the rationale for doing that. So yeah, from my perspective, there's no questions. Any other questions from any other trustees or? No? Okay. Great. Well, I guess with that, I guess we will bring the meeting to an end. I guess we have to take a roll to end the meeting. Danae?
Yes. Max Starks,
Yes.
Mary Kate Mirren,
Yes.
and Maurice Lindsay. Maurice?
You're on mute.
Sorry.
Oh.
Yes.
Thank you. Thank you.
Great. Thanks so much, Mike. Really appreciate you.
Yeah,
Sure.
great job, Mike.
Yeah,
as
happy to
always.
do it. And Andre, if it makes sense, I'm happy to have a chat just to bring you up to speed on some of the history and anything that could be helpful as you kind of get on board and learn about this. And maybe Dorothy, you and I can connect with her and try to set something up as appropriate.
Absolutely.
Okay.
Great.
That's great. Thank you.
Great. Thanks all. Have a good night.